Welcome to today's presentation titled What are the tax implications of becoming a landlord? And specifically, what the landlord needs to be aware of and what to do to ensure they remain compliant and manage the tax affairs. So perhaps you're watching this because you know that being a landlord has tax implications. You need to know about property tax and where to find that great information. And you need to know who to speak to ensure your tax affairs are managed effectively. So we're going to look today at the taxes that are paid by individuals in the UK who own property. We're going to look at taxes paid by limited companies who own properties in the UK. And we're going to look at the bit of a difference between the own name and limited company, just compare and contrast on a couple of points, and what actions landlords must take, and then the best sources of information. So what are the main tax implications for UK landlords? So firstly, the implications for a UK landlord can differ significantly depending on whether the property is owned in your own name or through a limited company. And there's an overview of taxes paid through a company's ownership cycle for both scenarios. So firstly, owning a property in your own name. So when you buy a property, you pay SDLT, Stamp Duty Land Tax, so stamp duty for short. It's paid on the purchase price of the property. There's over a certain threshold. Those thresholds do change from time to time. And if it is your second property or additional home, like a buy-to-let investment, then higher rate does apply. So do look at what those rates are online. So in your own name, when you're owning and renting a property, income tax is paid. So rental income is taxed at the landlord's marginal rate of income tax, perhaps 20%, perhaps 40%, or perhaps 45%, after deducting the allowable expenses and any mortgage interest relief that you are allowed to claim back. National insurance may also be payable if the landlord is running the property as a business. So that's when you're owning it, and when you sell the property, CGT is due, so capital gains tax. Payable on the profit, and that's a gain from selling the property that is no longer the landlord's main residence, with rates depending on the total taxable income, so 18% at the moment for basic rate taxpayer and 28% for higher rate taxpayers. But do research those numbers yourselves, speak to your accountants and tax advisors to get best information in that area. Let's have a look at how a limited company pays tax. So again, it starts off the same. Stamp duty land tax is still applicable at the same rates as for individuals, including the higher rates for additional properties. It differs now because when a limited company owns and rents a property, corporation tax is paid. So rental income and any of the profits are subject to corporation tax. Currently, that is set at 19%, but as we know, corporation tax can go up and down. So do look at the rates applicable. And no national insurance is due. Unlike personal ownership, no national insurance contributions on rental income within a limited company. Again, when you sell the property, there's a bit of a difference here. Corporation tax is paid on the capital gain. So profits from selling a property are subject to corporation tax, not capital gains tax. And the rate is the same as a corporation tax on the rental income. So again, at the moment, that is 19%. So here's a couple of differences between owning it in your own name and owning it in a limited company. So the biggest difference that a lot of people talk about is the mortgage interest. For personal ownership, there is a relief, but it's restricted to the basic rate of tax, which is 20%. In contrast, and this does make a big difference for some people, is that limited companies can deduct the full amount of mortgage interest from the rental income before calculating corporation tax. So tax rates. Personal ownership involves paying income tax at 20, 40 or 45%, whereas limited companies pay corporation tax, and that is currently at 19%. However, extracting profits from a company, perhaps through dividends, can incur additional taxation. So a couple of the points. Flexibility in tax planning. So limited companies can offer more flexibility in tax planning, such as retaining profits within the company for reinvestment. And administrative burden and costs. So owning property through a limited company involves additional administration and costs, including the company formation, that company must be set up in the first instance, filing annual accounts, that must be done every year, and potentially there might be a difference in the mortgage rates that a individual can get and a limited company can get. So mortgage advisors will have the best information to hand on that point. So what actions do you need to take as a landlord? So firstly, keep detailed records. So maintain accurate records of income, expenditure, and therefore the profitability of your property business. File self-assessment tax returns if you own it in your own name, and understand your expenses. So identify all of the allowable expenses and deductions. Again, your accountant or tax advisor can help you identify and record all of those deductions that you are allowed to offset in your business. And stay informed. That's one of the main points here. Stay informed and keep up to date with the changes in tax law and things that affect landlords. So to do that, what are the best sources of information and advice? So firstly, tax professionals. So contact a tax professional. It could be your accountant or it could be a property tax specialist, which we would recommend. And they can help you sort through some of these issues. You can join a property association because they have lots of help and support around them. Government resources, so refer to the government websites for tax regulations. And online platforms can help you as well, but make sure they're from reputable sources. So in summary, we've looked at the taxes paid by a UK individual, and we've compared those to the taxes paid by a limited company and drawn some differences between the two. We've looked at what actions landlord must take and the best sources of information. So if you've enjoyed today's presentation and would like me and my team's help to talk about any of the issues, we are not tax advisors and we are not accountants, so it's not professional advice in that respect, but we are letting agencies and property professionals, so we can give you a view. Book a phone call with a member of my team. We have some spaces to make calls with you, but when the spaces fill up, they're gone. We'll listen to your issues, we'll understand what you want to achieve, and we'll give you our best advice, which in this area will probably mean refer you to one of our trusted tax and accountancy partners. If at the end of the phone call it feels like we're a good fit, we'll see if we can work with you. Until next time, subscribe to this channel, like and comment on the video below, and click on the links to get other free content. So links are down below. And here is to the success of your property business.